I will begin this installment by mentioning that I am not a financial advisor, and this is for informational and educational purposes only. The strategy that I am about to outline involves a high-risk, short-term trading of volatile assets. There is a real risk of loss. Market conditions are unpredictable, and by following this or any trading strategy, it is possible to lose some or all of your invested capital. Please do your own due diligence and never trade money you cannot afford to lose. With that said, good morning. We are about to launch a weekly trading plan, and we are starting with the single most important sector of the global economy, financials. So for week 1, spanning January 12th to January 16th, we will place $500 into XLF, the Financial Select Sector SPDR Fund. I mean, why start here? Because in the stock market, banks are the leading indicators. They report earnings first. They tell us if the consumer is paying their bills, if businesses are borrowing money, and if the economy is actually healthy. If the banks catch a cold in week 1, the rest of the market will get the flu by week 3. We are not guessing on direction. We are trading the volatility and momentum of the official start of the earnings seasons. We are positioning ourselves directly in the path of the news cycle. All right, so let's dig into why we're going with XLF this week and why we're confident that XLF will move this week. Well, we have 3 specific drivers. First of all, the higher for longer net interest income. Entering 2026, interest rates have stabilized but remain relatively high compared to the last decade. Banks make money on the spread, the difference between what they pay you for your savings, which is still low, and what they charge for loans, which is high. We expect reports from major players like JP Morgan and Bank of America to show robust net interest income. This is the engine that drives bank profitability, and right now, that engine is running hot. Secondly, is the investment banking revival. Throughout 2024 and 2025, we saw a slump in IPOs and mergers, but Wall Street has been pricing in a massive rebound in deal making for 2026. We are looking for confirmation of this in the earnings calls. If CEOs mention a strong pipeline of deals, fees go up and stock prices fly. We are buying XLF to capture this optimism. Third and last is the credit quality reality check. This is the risk factor that drives volatility. Investors are terrified of a recession. They want to know if Americans are defaulting on their credit cards. And by owning XLF, we are essentially betting that the U.S. consumer is bending but not breaking. If the banks announce that loan loss provisions, the money they set aside for bad loans, are fewer than feared, we will see a massive relief rally. Okay, so let's look at the calendar. This trade isn't vague. It's built around what's happening this week. So on Monday, January 12th, we're going to enter at open. The market will be quiet, waiting. This is the calm before the storm. Tuesday, January 13th, this is the main event. So JP Morgan Chase, JPM, reports before the bell. JPM is the heavyweight champion of the sector. When CEO Jamie Dimon speaks, the algorithms listen. If JPM beats earnings, XLF likely goes up immediately. So Wednesday, January 14th, is when we expect the floodgates to open. We expect reports from Bank of America, Wells Fargo, and Citigroup. This is the confirmation day. If JPM was good on Tuesday, these 3 usually confirm the trend on Wednesday, pushing the sector higher. Thursday, January 15th, we likely hear from the investment banks like Goldman Sachs, asset mergers like BlackRock. This shifts the narratives from savings accounts to stock market health. We are holding through this entire sequence to capture the cumulative momentum. So what's the execution look like here? At 9:30 a.m. Eastern Time on Monday, January 12th, we'll buy $500 of XLF. We use a market order. We don't really care if we pay $42.50 or $42.60. We want in before the Tuesday headlines. So what if we're wrong? What if JP Morgan says the economy is crashing? Because we own the ETF, XLF, and not just a single bank, we are insulated from disaster at a single company. If Wells Fargo drops 10% because of a scandal, but JPM and Goldman are up 2%, XLF stays stable. We're trading the sector, not the stock, but there's still some risk here. So we're going to hold until Friday, January 16th, after 12 p.m. Why Friday? Because often investors who are scared to buy before earnings will rush in on Thursday or Friday to catch up. So we're going to sell into that late week greed. So week one is about clarity. The rest of the market is guessing what 2026 looks like. The banks will actually tell us. By playing XLF, we are putting our capital on the most informed sector in the room exactly when they are handing out the report card. So tune in on Saturday to review the results and review what we'll be purchasing the following week.